Ladies and gentlemen, good day, and welcome to the Epack Durable Q2 and H1 FY26 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then zero on your touchtone phone. Please note, this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair. Thank you, and over to you, ma'am.
Thanks. Good morning, everyone, and a warm welcome to the Q2 FY26 earnings call of Epack Durable Limited. We have the management today being represented by Mr. Ajay Singhania, Managing Director and CEO, Mr. Narayan Lodha, Executive Director and Group CFO, and Mr. Rajesh Kumar Mittal, CFO. At this point, I'll hand over the floor to Mr. Narayan Lodha for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Thank you, Bhumika. Good morning, everyone. I am Narayan Lodha, Executive Director and Group CFO of Epack Group. I warmly welcome all of you to our Q2 of financial year 2026 earnings conference call. The Board of Directors has approved the Q2 of financial year 2026 result on 4th November 2025. And I trust you have all had the opportunity to review them. Epack Durable is India's second largest ODM for room air conditioning. We are consistently executing our strategy to diversify beyond core RAC into higher growth categories, namely small domestic appliances, large domestic appliances, and component business. Joining me on the call today is Mr. Ajay Singhania, our Managing Director and CEO, Mr. Rajesh Kumar Mittal, our Chief Financial Officer. They will take you through the details of our operational and financial performance for the quarter. Thank you. With that, I now hand over to Mr. Rajesh Mittal, our CFO, to take you through the key financial highlights for Q2 2026.
Thank you, Narayan. Thank you. Good morning, everyone. Welcome to our earnings conference call to discuss the performance of second quarter for the financial year 2026. Let me first thank you, our host for today's earnings call, DAM Capital Advisors. Now, let me give you some of the key financial highlights for the quarter and for the first half year ended for the financial year 2026. For the second quarter under review, our revenue from operations stood at 213 crore rupees, which declined by 43% on quarter-on-quarter basis. The EBITDA was 0.5 crore rupees, which declined by around 95% on quarter-on-quarter, with EBITDA margin reported at 0.23%. The net loss for the quarter was around rupees 22 crores. For the half year ended, revenue from operations stood at rupees 876 crore, which declined by 24% on year-on-year. The EBITDA was rupees 56 crore, which declined by around on year-on-year, with EBITDA margin reported at 6.44%. The net profit was around 0.6 crores. Now I would request our Managing Director and CEO, Mr. Ajay Singhania, to brief you on the operational highlights. Over to you, sir.
Thank you, Rajesh. And once again, good morning, everyone. The second quarter of FY26 continued the muted journey for RAC with an overhang from Q1, primarily due to unseasonal rains and especially the time gap between the announcement and implementation of GST rate reduction on air conditioners from 28% to 18%. So as there was an overhang of inventory from Q1, this definitely impacted the sales and production in Q2 as well. But thankfully, the second half of Q2, especially the end of September, saw some cheer in the market with AC inventories getting liquidated and channel inventory being offloaded. However, post-implementation of GST, we witnessed this rebound for a shorter duration, especially during Navratri and Diwali, wherein the surge in customer demand pushed AC sales and also pushed liquidation of inventory from the brand warehouses. Over the past few weeks, inventory levels have definitely come down and channel movement has improved meaningfully. We expect this movement to further continue through the current quarter, thereby driving the demand and with enhanced affordability, improving customer sentiment and healthy underlying demand. For a segmental perspective, our RAC segment witnessed a decline of 76% quarter-on-quarter basis for the reasons I stated just. However, other segments demonstrated strong momentum. Our focus in diversifying our overall revenue, the three pillars of small domestic appliances saw a growth of 45% quarter-on-quarter, led by healthy order inflows across both existing and new products, particularly with encouraging demand of air fryers. Our component segment, the second pillar, also saw a robust growth of around 73% quarter-on-quarter, supported by a solid order pipeline of different components for non-AC products. Our LDA segment also reported a significant 466% growth quarter-on-quarter, driven by our continued focus on expanding the customer base. Notably, our product business contributed 79% of the total operating revenue during quarter 2, reaffirming our customer confidence in core offerings and highlighting strong market adoption. In line with our strategy to scale and diversify, we also took a significant step in broadening our component segment. This diversification is a deliberate move to reduce concentration and position us in adjacent high-growth industries. We see this a long-term growth lever that strengthens our portfolio and opens new opportunities across sectors. We remain committed to long-term value creation through strategic capital investments aimed at expanding capacity and supporting our diversified growth roadmap. By end of quarter 2 FY26, we made steady progress across multiple key locations. We incurred approximately 129 crores of capex in Q2 FY26, primarily directed towards capacity expansion and equipment installation. Our basic infrastructure and building is now ready and we are putting up the plant. These investments, along with the upcoming City facility for Hisense, growing customer engagement post-implementation of GST cut from 28 to 18%, we have witnessed a strong rebound in demand. The festive season, particularly during Navratri and Diwali, saw a surge in customer durable sales, especially air conditions, and expecting the momentum to continue, we firmly believe that H2 would see a rebound in the growth of AC industry overall. The continued expansion of product portfolio positions us well for the future. With a strong foundation in place and focused execution, we remain confident in achieving our full-year targets and sustaining healthy revenue growth going forward. With this, we now open floor for Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yes, thanks for the opportunity. Sir, two questions. Obviously, Q2 was impacted, but how do you see Q3 considering many companies have called out that October was also a soft quarter because generally there is a mini summer or October heat, but this time we have seen monsoon remaining active in many parts of India. So, probably weaker start to the quarter Q3. And secondly, the inventory also needs to change by end of 31st December, considering the change in BEE norms from January. So, how do you see Q3 likely to pan out? That is question number one. Question number two, if you can indicate the guidance for this year, FY26? I guess earlier call you had alluded to around 30% revenue growth this year. So how should we build on to that now in the model? And last question, in terms of any update that you can share on Hisense as well. Yeah, that's it from my side. Thank you.
Thanks, Anirudh. I think very relevant question under the current circumstances. Obviously, like I started sharing, the GST rate cut and the cheer which it brought to the market was kind of very short-lived, lasting probably only for 2 weeks or so. And beyond it, obviously October, we didn't see much uplift in the market sentiments. So the GST rate cut could only promote, it definitely helped liquidate inventory in the channel to a certain extent, but not as high as expected. So there has been definitely reduction in the overall inventory levels in the trade, and we saw some movement in inventory from the branch again to the secondary market. But it was short-lived, and yes, definitely the beginning of Q3 seems to be kind of muted. So my current sense guides me that overall FY25-26 for the industry at best could be a flattish kind of a year for the AC industry. And hence our efforts into diversifying, I think, will play a very critical and important role for us to drive growth for the current financial year. So as we can see the uptick in our SDA, LDA and other categories, we firmly believe that this will continue to grow, and AC at best could be flattish for the industry, and we could see similar kind of status even for Epack. So our revenue guidance, if we talk about for the current financial year, will continue to grow with our diversification efforts, and for the projections about the AC growth, we keep our fingers crossed, still looking at the kind of RFQs that are coming into the industry. So overall, calendar year 26 definitely seems to be very promising with all this, but yes, definitely the BE upgradation and all this are definitely jeopardizing the current H2 growth as well. In terms of the update on Hisense, the new facility which we are putting up dedicatedly for Hisense is now completely ready, and the trial production and all the licenses and approvals have been received, and we are planning mass production rollout towards the end of December, first week of January is when we plan to start the mass production for the Hisense air conditions.
Okay. Sure. Understood. So, and I guess the price hikes which we may need to take will be in the range of 7 to 8% for RAC from January to comply with new norms. That's right?
So again, on the price hike side, there are going to be two impacts in the coming season. One definitely is that compared to last season, which abruptly ended in March, April, the dollar rate has gone up. The commodities, especially copper and all, have almost increased by 15 to 20%. So that is one which will definitely lead to price increase. And on top of it, the BE rating upgradation will also have its own impact. So yes, anywhere between 5 to 7% is definitely the increase on the cards, which will set off whatever benefit was passed on in terms of GST reduction.
Okay, got it. So, and last question, I guess the PLI benefit that the industry is getting, it's till end of FY27. That's right, no? So post that. Sorry.
Right. So this year is the fourth year for Epack to accrue PLI benefit, and then FY26-27 will be the last year for which the amount will be received in FY28. So the 5-year window for the PLI will be ending in FY26-27.
Okay, so most likely the industry will have to take one more round of price hike again beginning in FY28 to manage the margins.
Yes, hopefully yes.
Okay, sure, sir. So this is very helpful. Many thanks, sir.
Thank you, Aniruddha. Thank you.
Thank you, sir. The next question is from the line of Tanay from DAM Capital Advisors. Please go ahead.
Hi, sir. Good morning. Thanks for the opportunity. Sir, my first question is, given you mentioned that obviously the inventories did sort of liquidate to an extent at the channel level, what will be the current inventory levels, let's say, between channels and brands currently?
So, Tanay, again, these are just estimated figures. We believe that the channel inventory at the end of Q1 was roughly around 5 million, with almost 3.5 million in the channel and close to 1.5 to 2 million with the brands. So, at the end of Q2, we believe that this inventory has come down to the level of almost 2.5, 3 million. So, it has almost reduced by 50% or so. So those are the estimated numbers, what we have kind of put down in our discussion with most of the brands. So the channel inventory has definitely reduced almost 50% in the last quarter.
And so that would broadly be, let's say, around 2 odd million with the channel and remaining 1 million with the brand. Would that be a fair split?
Yeah, as a rough estimate, that's what numbers could look like. Maybe 1.7 million with the channel and another 1 million with the brands put together.
Got it, sir. So my second question is, given that the BE rating is on cards, let's say Jan onwards, are we seeing any sort of new RFQs turning into orders this quarter onwards, or is that yet something which is not common given that we have to liquidate the old inventory yet?
So, Tanay, here's something interesting is there, especially since the BE rating is getting implemented from 1st of January, and it is not necessary for the channel can still carry the inventory from the previous star-rated products. So, we see a unique mix here since the price increase on the 5-star products is going to be much more as compared to the 3-star product. A lot of brands are continuing production, especially of the 5-star products, with the current BE rating, and which they probably want to market or sell in the upgraded situation. So one, in the current quarter, we will see a lot of 5-star getting produced. And secondly, yes, most two brands are also starting production of the new star-rated products from mid of December onwards.
Okay, sir. So my next question is, let's say in terms of SDA, right, we've seen very strong growth, and obviously it's got to do with the fact that one bit is the air fryers picking up pretty well. But what are the other key products which is doing well for us? And if you could give any color in terms of, the breakup between the products, and how was this demand a lot led by festive sales? And if yes, is it yet sustaining at these levels going forward as well?
So for the SDA category, Tanay, yes, air fryer definitely being a new category, we saw a significant movement, and with us, Epack associating with most of the larger clients, this definitely has been a remarkable ramp up of operations for the air fryers. But together with air fryers, our other products which we have created the lineup like vacuum cleaners, coffee makers, infrared cooktops, nutri blenders. So almost all the products have either started production towards the end of Q2 or current month we are seeing the productions being ramped up. And as committed earlier that we intend to add almost close to 15 new customers, 5 were onboarded in the last quarter, and another 4, 5 are getting, we have already received the approvals and are in process of getting onboarded. So with the continued focus on SDA, we see that this growth momentum to continue further. And as we are adding new product lines, the overall SDA will continue to show a strong growth momentum.
Got it, sir. And so just if I could ask another question in terms of working capital, right? It's seeing a significant increase in H1. So, what is the expected working capital position and let's say the debt position which we expect at the end of FY26? If you could give some flavor on that. And just one more last question in terms of the component PLI, given that we started seeing some sort of approvals coming through from the government, are we planning on doing anything for camera modules? And if yes, would it be for mobiles or auto?
For the working capital, Tanay, since we were carrying huge amount of inventory overhang from the Q1, definitely those inventories converted into paid inventory for us as we marched through quarter 2. And since there was no movement in the finished goods, definitely the working capital increased, and hence our inventory days have also increased. So as you can see in the presentation shared, one is the increase in the inventory days, and second is the reduction in the payable days, which means there was no new purchase. All the old purchases were already paid off. So that is something which has impacted the overall working capital cycle. Now, within the current quarter and going forward, as this industry starts liquidating, we will see definitely improvement in the overall working capital cycle or days. But again, to achieve something what we did last financial year would be difficult since the inventory has already impacted a lot during the current H1. Anything, Rajesh, you want to add to it?
And Vinay, this, as you rightly quoted, you have seen the results also. Then this working capital, as MD sir has also mentioned, this working capital, there were two type of jumps in the loan this time. One is the working capital requirement, that is because of the inventory lying up in the books, and we have paid our suppliers on time. This is why there is some jump in the working capital requirement, and some part of the term loan which has increased because you see that we have made some amount utilized some amount in the capex in the first quarter and second quarter, around 160 crore, out of which around 70 crore, around odd number, we have utilized out of our IPO proceeds, and some amount IPO proceeds has been utilized mainly for building, and some for capex like plant and machinery we have utilized for our subsidiary against the term loan.
Basically, Hisense facility, the term loan is being used for our Hisense facility, which is now ready, and now we are putting up the plant and machinery. So that's why for this quarter, consolidated basis, you are seeing some jump in this.
In terms of second question regarding component PLI Tanay, so in terms of which is called the ECMS scheme, the Electronic Component Manufacturing Scheme. So at Epack, we had formed two new entities, Bumjin Audio Products Private Limited and Epack Components Private Limited, of which the components, we would manufacture the electronic components. The Bumjin Audio Products intends to make components of audio components like TV speakers and microphones and all this, for which the facility is currently under setup. And the second Epack Components Private Limited again is a new facility with greenfield facility targeting certain other components allowed under this scheme, for which the construction is ongoing, and the set of components to be produced there we would share in the upcoming quarters as we enter into certain strategic agreements with them.
Got it, sir. So just wanted to understand the net debt position or the debt position at the end of this year would be helpful, given that, the working capital and the term loan has sort of increased. Just wanted if we could get some flavor on that. Thank you.
This, you see, our total borrowings in the books is around 680 crore or so, and we are having around 126 crore around money in our books. So net debt would be around 500 crore or so.
Thank you, sir. Thanks.
Thank you. The next question is from the line of Rahul from PNB MetLife Insurance. Please go ahead.
Hi, sir. Thank you for the opportunity. Am I audible enough?
Yes, sir.
So, sir, the weather has been, erratic this year.
Can you be louder?
So, can you come closer to the mic?
Sure. So, sir, weather has been erratic this year, and there is also a case of La Nina this year. So, to what extent can the demand be impacted, and how are you planning the inventory given the La Nina and rating change here?
So the unseasonal rains and the erratic behavior of the weather definitely has impacted the overall AC demand in the country. Based on the industry estimates, we see that overall industry has degrown to the extent of almost 35% plus till end of quarter 2, and similar kind of degrowth is also seen in the numbers shared by Epack Durable. While we see definitely some rebound in demand in the upcoming 2 quarters, overall it is expected that at best the industry could end up being flat as compared to the last year, or possibly there could be some degrowth. So this entire 35% kind of a degrowth for the current financial year seems quite difficult to achieve towards the end of the fiscal year FY 25-26. But keeping fingers crossed, we expect overall level the industry to end somewhere being flattish at max.
Okay, sir. Sir, my second question is, so to what extent have you backward integrated in terms of components now?
In terms of backward integration at Epack Durable, we make components by value to the extent of almost 65-70%, which includes components like copper parts, printed circuit board controllers, PCBAs, cross-flow fans, BLDC motors under our subsidiary Epack, all plastic parts, sheet metal parts, everything. So technically, if I talk in terms of large component, except compressor, we make almost all the key components in-house. So that's almost 65-70% by value of components are being produced under a single roof at each of the facility.
Sure, sir. So thanks a lot. Thanks a lot for the opportunity.
Thank
and
you.
all the best.
Thank you. The next question is from the line of Arshia Khosla from Nirmal Bang Institutional Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. So my question is on the LDA and SDA segment. Any new client additions that we've done in quarter two? And for the LDA, what products are seeing, what products are seeing that growth?
Thanks, Aisha. For the LDA and SDA segment, we have diversified our product portfolio. We have added newer products in this fiscal year, like air fryers, and then we've added coffee makers, and going forward, we are adding Nutri Blender and other products. So in terms of new customer addition, we have added several key new customers like Group SAB, V-Guard, Linklock, Flam, Nook, American Micronics. So there's been an addition of at least 6-7 new customers, of which 4 or 5 are really big and significant customers. And then the opportunity to cross-sell to our current existing clients, whom we were earlier supplying only the induction cooktops or the mixer grinders, the newer categories, whatever we are adding, are also getting sold. So this all is helping us ramp up our product categories. As we are adding up more categories, we see our relationship with the existing customers to grow further. So that will help us increase our wallet share with these customers. So this definitely remains a key growth driver for us. Similarly, for LDA, we were making especially coolers. So in coolers also we see a definite growth coming forward. Our air coolers with both Symphony, Voltas and Bajaj continue. Although being a cooling product, there was an impact on cooler sales as well. But then our production is ramping up and we are adding a newer line as well. So there again we see the continued momentum, and we are also in talks with certain other newer clients to increase our customer mix for the LDA categories. So in LDA, we also have the washing machines, the top-load washing machines, what we started in the beginning of this financial year. So therein now the growth has been kind of, or the production has not been significantly ramped up in the last 2 quarters, since it took much more of approval time than expected or anticipated by us. But by now, all the approvals are in place and certain key new relationships have already been established. For further, the field trials with almost all the key brands are completed, all the reliability is done, and we are seeing a ramp up in production as we currently talk.
Thanks, sir. That's helpful. And secondly, on the new BE norm changes, so have the brands started placing orders for the new products, and have you started the production on that?
As far as new BE products or air conditioning is concerned, yes, the RFQs have already been received and commercial closes done with most of the brand customers. So currently, the products are under testing and validation, so there's still a month to go before the production starts. So for most of the brands, we see production starting towards the mid of December or the last week of December is when the production will actually start for the new BE rated products.
Got it. Understood, sir. And lastly, sir, on your guidance for FY26 revenue and on the EBITDA margins.
I think in the previous question also, I was very candid to share the guidance. So our guidance on growth for all the other three categories, the SDA, LD, and components, definitely we can see an upside to whatever guidance we had given earlier. However, for AC, yes, we are little pessimistic about the growth of AC, and we believe that the industry at best could be flattish. So, and any growth over the last year numbers for AC will definitely be a challenge for us as well as the industry. But at the same time, our diversification efforts for all other categories like SHA, LHA, components, etc., will definitely help us secure definite growth over the last year's revenue.
Got it, sir. So basically, for REC, we'll be at par with the industry?
That is what the best we can expect under the current circumstances.
Got it. That's helpful, sir. Thank you.
Thank you. Ladies and gentlemen, to ensure the management can address questions from all the participants, please limit your questions to 2 per person. If you have a follow-up, kindly rejoin the queue. The next question is from the line of Mr. Achal from Nuvama IE. Please go ahead. Mr. Achal, kindly unmute your mic.
Can you take other call?
Yes, sure. The next question is from the line of Dipali Vansal from Ventura Capital. Please go ahead.
Hello, sir. Good morning. Hard set of numbers this quarter. Actually, in this call, you mentioned about coffee maker again and again. I think twice you've mentioned, but in your PPT, you've not mentioned that it has been launched or started production. New products are Nutri Blender and vacuum cleaner. Would you able to define what are their revenue sales, production capacities? How much can we make? How much can we sell? Hello.
Yeah, Dipali. I'm just looking at the numbers to share with you.
Okay.
So towards the end of quarter 2 and the current month, I believe we started the 2 products what we're talking about, both the coffee makers. Coffee makers were done in quarter 2. It was in
quarter 3. Blender or vacuum cleaner? So we have started Nutri Blender.
Okay. So coffee Nutri Blender and vacuum cleaner we started in quarter 2. And coffee maker is something we just started in first week of Q3. So I'm sorry.
What sir wanted to say that we have already established the line. Still it is the testing phase. So actual sales has not started, but everything, PKD, everything has been done. So for coffee maker
got started
like just right now.
Yeah.
Today or tomorrow it will be done. So once the final testing has been happened, then it will be done. So in quarter 2 we have already started the two new products, and this will be in quarter 3. So we have essentially Nutri Blender and vacuum cleaner in quarter 2. And definitely infrared cooktop and coffee maker. The both will be started in this quarter. The line and everything has already been established. The test product is already done. For the final product is on the process.
All right, sir. So let's assume that we had a bad year this year, bad monsoon, everything. What if we see another bad year next year? So how do we handle such circumstances? Because as we can see that we ended up in cash losses in this quarter, and next quarter is also not looking good. The RFQs are also not looking very promising right now. So what if we have another bad year? How are we equipped to handle such circumstances?
So Deepak, in terms of the RFQs and outlook for FY, or rather this upcoming season, the calendar year 26, is definitely very promising. And when we are talking, so there are 2 aspects when we are talking about the current financial year, because the first half has been extremely muted with the industry degrowing at 35%. So recovering that 35% in October, November, December, or even the H2 of the year seems almost unrealistic. Hence, we are saying that for the financial year FY25-26, yes, the industry could at best be flattish, because recovering the 35% lost sales will not be possible. At the same time, the future outlook for the industry for the calendar year 26-27 is extremely promising. So the impact of GST reduction from 28% to 18% kind of will be available for the entire year of calendar year 26 and onwards. So that is something which will definitely promote the overall demand for the upcoming season. So the upcoming season RFQs are extremely good, and most of the brands are planning very robust quantities, and we are very confident that overall the season of FY26, the calendar year 26 is going to be extremely good. And as we are ramping up production and discussions with our the order book for the calendar year 26 is extremely healthy. So there is no reason for us to be pessimistic for the calendar year 26. Everything is lined up very well. The order book is very strong. We have closed the orders with most of the leading customers for the calendar year 26. So the overall projection for 26 definitely is very good. When we say that FY26 seems to be kind of muted, is because of whatever has been lost in last 6 months seems kind of little difficult to recoup or regain. So from that context, yes, FY26 could be at best muted, but overall the coming season is extremely promising, and all the brands are planning growth over the current financial year.
So we are actually looking to double the capacity by FY27, which we were initially planning. Is that still a course of action?
Yeah, that definitely is the course of action, and especially with our new facility for Hisense coming up, a lot of push is there on export sales to the Middle East and African country by Hisense. So all this we see definitely will help us leverage our capacities better in calendar year 26 and 27. So there is we are not cutting down any estimates for the overall growth in the calendar year 26-27. That all is on track. The only thing is the current lost sales for the industry seem and would be unrealistic to recover in the next 6 months of the second half of FY26. So I think we have been very candid to share that it would be extremely impossible for the industry to recover the lost sales of H1 in H2.
All right, sir. That's it from my end. Thank you.
Thank you. The next question is from the line of Mr. Achal from Nuvama IE. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity. Sir, just a clarification. On one hand, you said that, the industry has seen a 35% decline YY. On the other hand, you were saying that, at best it can be flattish. But I'm just perplexed about the math. If the December quarter will not, I mean, typically the 4Q and 1Q are the strongest quarters, right? So you think it can get compensated in Jan to March period, especially when the retail demand actually kicks in only in Feb onward?
So absolutely, Achal, I'm in line with your thought process, and this is what we are currently discussing, that the lost sale of H1 close to 35% seems unrealistic to recover in just one quarter sales of Q4 for the current financial year. With South, the predominant demand in South is only there for the Jan-Feb-March period, whereas North kicks in only after March. So for North, which contributes almost close to 40% of the overall industry sales, it is mainly March, April, May, June, July, that's the season, and which was muted for the current year, which has led to all this degrowth. Hence, we agree with you that the current lost sales would be difficult to recover in the current financial year. However, the overall demand outlook for calendar year 26 is very, very promising.
Got it. And just a clarification on the festive season, whatever you have gathered, what kind of growth? Are we seeing a 15-20% growth or 70-80-100% growth for RAC?
The festive season cheer was there mainly only for the 2 weeks, the last week of September, 22nd to 30th, and then probably will continue for another 5-7 days. So the beginning of October was the cheer continued. That led to significant sales and reduction in the trade inventory, but not to the level as was expected initially. So the first few days the sales was extremely remarkable, and everybody became very cheerful that almost all the inventory would be liquidated. So that was only a 2-week cheer. And after that, again, the demand has been kind of sluggish in the second half of the October.
So effectively, maybe a 15-20% kind of a growth on a year-on-year basis for the comparable period?
So based on certain channel checks, reports received and then discussed with the trade partners, we believe, yes, a month-on-month, there was an increase of almost 20%. So that was only for a month of September, let's say, which obviously is it's on a very low base. So on that kind of September, October sales, there was a 20% jump, but overall quarter growth was not there. Because 6 weeks of the quarter were already lost between the announcement and the implementation from 15th August to 22nd September. So that 6 weeks were totally muted, both in terms of sales and production.
Correct, which means that is just a pent-up demand. So on a cumulative basis, the growth will not be very large at the retail end. So I was just curious to understand that.
Absolutely.
And sir, just wanted to understand, yeah.
So may we please request you to return to the question queue for follow-up questions, as there are several participants waiting for their turn.
Sure. Thank you so much.
Thank you.
Thank you, Anju.
The next question is from the line of Shreyas Jain from 3A Financial Services. Please go ahead.
Hello. Am I audible?
Yes, sir. You're audible.
Yes, sir. The same situation was being observed in financial year 2024. So was there the Q2, Q3 was sluggish, Q4 also was quite we started getting fresh orders from Q1 FY25. So will we see similar situation in this year as well? Do we see fresh orders coming up from Q4 end and Q1 25 starting?
So yes, the outlook for calendar year 26, so Jan to December of 26, definitely, like I'm sharing again and again, is very positive and very bullish for almost most of the brands. So currently, as we talk, we are sharing that our order book for the Jan to December period of 2026 is extremely strong. So the orders have already been closed with most of the major brands, and currently, as we talk, the product is either getting finally tested or the testing is already closed. So the production starts from mid of December. That's when the actual production starts for the calendar year 26. So the overall outlook for 26 is strong, and we will see rebound in manufacturing happening in Q4 of this financial year, or Jan to March, and then March to June period is when we will see a lot of production activity happening and being ramped up significantly.
Perfect, sir. And what would be the effect of new energy norms on the older inventory and the realization per unit of AC?
So the older inventory is allowed to be sold in the trade as long as it is available in the channel. As we are sharing that the improved BE ratings, the cost is going to increase. So that will give some leverage to the channel partners to liquidate the old rated products, definitely. But the only norm is that the old rated product cannot be manufactured beyond 31st of December. So that's the norm, and hence we will start the new production of new rated products from somewhere around mid of December.
So do we need to modify any components, or the older components are eligible, sir?
At component level, all the components will be used. Only the overall at product level, there are some design changes happening which help us improve the energy efficiency. But in terms of inventory, whatever we have is usable both in the current rated product as well as the new rated product. So there would not be any inventory obsolescence because of the B rating upgradation.
Great, sir. One last question. Could you please help us know that what is the strategy of brands? Are they opting for more manufacturing in-house or outsourcing? Could you please provide some light on that, sir?
Shreyas, like we all know, I believe there is no absolute strategy around this, but of the top 10 brands sold in India, 9 of them have their own manufacturing facility. Despite this, and this top 10 brands contribute almost to more than 90% of the overall AC market. And despite this, their dependence on OEM or outsourcing today currently stands at more than 35%. So this evidently reflects that no brand wants to do 100% manufacturing in-house. They always want to balance somewhere between manufacturing in-house and outsourcing. And this gives us the confidence that we are an indispensable partner for most of our larger brand customers. We have grown with them over the last 20 years and we continue to grow. And so it's like walking together, it's not optional, and together we continue to grow.
Okay, sir. Thank you so much, sir. Okay.
Thank you. The next question is on the line of Bala Subramanian from Arihant Capital. Please go ahead.
Good morning, sir. Thank you so much for the opportunities. Sir, some custom issues were there, especially for copper tubes, and what is our planning in maybe next 2 to 3 years time frame? We are planning any backward integration for copper tubing, or we still looking for outsourced locally, or we will continue to import from some of the countries. If you could, which are the price or supply source is coming from?
Okay. So Mr. Bala, in terms of the SCN from the Customs Department for copper tubes, the SCN was received by the entire industry, not only manufacturers but all traders all put together. So for which jointly at industry level we are we have filed a case in all the states with the Customs Department. We have already filed the case and we are jointly fighting it. And as an industry, we remain very confident that we have a very strong case to put up against the imposition of retrospective duties on imports from FTA countries, so that case remains with the courts now. And this is the hearings till date. As an industry, we are very positive that there will be a revision on this. So that's where we stand in terms of the SCN for the customs duty on copper tubes. In terms of sourcing strategy, already a couple of new suppliers have come up in the country, like RR Cable, Global Copper, Mattube, Hindalco. So all of them have already established capacities for manufacturing of copper tubes, and hence there is no need for Epack to look into backward integration and manufacturing its own copper tubings. We have strategic relations with both domestic as well as import suppliers from FTA countries, and we'll continue to source with them.
Okay, sir. So I think for Hisense JV, we have an ambitious target of 1 billion incremental revenue over the next 5 years. And what are the specific measurable milestones for this JV over the next 12 to 18 months in terms of production volumes, client approvals, or initial revenue? And how much additional investments we are planning for Hisense? I think we have a capex plan of around 450 to 500 crore, including multiple JVs and subsidiaries. If you could break down what kind of ROIC and payback period expected in those investments.
In terms of our Hisense dedicated setup for Hisense to manufacture the entire range of appliances, so there are 3 phases to it. In phase 1, which is setting up of AC production, the plant is now already commissioned, and as we discussed, the trial productions are ongoing there, and we expect mass production to start towards the end of December or first week of January. Then we see mass production starting for air conditions. This would be an OEM product, which is the global portfolio of Hisense and will be used to be marketed in the domestic India market as well as exports to certain Middle East and African countries. So for this, the capex is close to 100 crores in the capex for setting up the AC production line, which is now almost completed. On top of it, going forward, there is plan to start washing machine, both top load, front load, and semi-automatic, which the phase 2 is currently looking to be productionized towards the end of Q1 in FY27. So April, May is when we look at starting the washing machine production, and certain other products are also in pipeline. So all these 3-4 products put together in 5 years, the cumulative revenue is projected at close to 1 billion in revenue, which is 8,000 crores.
Okay. What is the breakup of capex of 450 to 500 crores?
That is there on the investor presentation.
That was part of the investor presentation we shared in the last quarter. almost 200 crores was additional investment for, I don't have it handy, but it was part of our last. Okay. Okay. So, Bhiwadi expansion, the planned investment was 125 crores. Sri City, both, the planned investment was 225 crores. And for Hisense facility, the planned investment was 100 crores, which I shared is now almost done. In quarter one, out of this for 450 crores, we did 45 crores of investment. And quarter two, like we shared, we have done almost close to 129-30 crores of investment is what's already done. So out of 450 in quarter one and quarter two put together, 175 crores is done.
Okay, sir. Thank you.
Thank you. The next question is from the line of Abhisar Jain from Monarch AIF. Please go ahead.
Yes, thank you. Hi, Ajay. Ajay, just wanted to know this Sri City CapEx other than the Hisense, that 225 crore which we are undertaking, and we have spent 64 crore in the first half. So two questions there. One is that which all product segments you are expanding there, and given the demand scenario and the increased competitive scenario, what is giving us the confidence in terms of the demand going ahead to put up such a large capex outside Hisense, because Bhiwadi is also getting around 125 crore additional capex. So just wanted your thoughts of what is the demand visibility on these capex, and if some firm orders are also there for these.
So Abhisar, in terms of the Sri City capex, the 225 crores of capex, 100 crores is into the building which is to be used by the wholly owned subsidiary of for Hisense. So the building is being built up in the Epack durable land and is being leased out to the JV. So that's where the 100 crore is being invested.
Oh, okay.
And two new product lines are being set up. So close to 50 odd crores is going into ramping up washing machine production. So we had originally invested in top load. Now front load and semi-automatic are also getting, the tools are getting manufactured. So that's the other upcoming product line for which 50 odd crores is going to be invested. And for new components, controllers and others, another 80 crores is going to be invested. So that makes almost 225 crores. 100 plus 50 plus 80, that's 225-30 crores is going to be invested overall in Sri City. And for the Bhiwadi investment, that's a greenfield facility what we're talking about. A new greenfield facility is getting constructed in Bhiwadi, for which currently the building is being under construction, and the product lineup, like we shared earlier, will be shared subsequently once the formal non-binding agreement, the binding agreements are signed with our partners. So it is something to do with the ECMS scheme, and once we have a binding agreement in place, we will share it with the industry.
Understood, sir. Thank you for this clarity. So the second question is on the washing machine side. So I understand that the initial ramp up and approval has taken some time. But sir, what would be your assessment on the outlook, say for FY27, even if we assume that the H2 also goes in, further ramping up slowly as we get more approvals. But for FY27, what kind of outlook can you provide on the washing machine side? And also, sir, if you can give the LDA number, what we did for Q2.
For washing machine, yes, the delay has not been some. We are almost delayed by 3 quarters in ramping up production. So that has made us now extremely cautious in terms of our further design capability, and as we are getting approvals from the customers, so now we are more realistic. We understand that this is one product which takes more time as compared to AC, in which we already have an established capabilities. So, and now we are very confident that with our top load almost approved, or rather already approved by the leading brands, going forward for us it is replicating our expertise. So as we talk, front load and semi-automatic is 2 other lines of products which we are now envisioning and for which the design development is ongoing. So with the complete range being available in FY27, we see that the order book is going to be extremely healthy, and at least 3 key customers or anchor customers are already onboarded as we discussed, and the quantities are extremely promising from all these 3 anchor multinational customers. So we see that an extremely good growth coming in FY27 from our washing machine category.
Okay, sir. And the LDA revenue for Q2? the last one.
For the LDA category?
Yeah,
LDA,
large domestic.
LDA, the base was extremely small. So, growth is like what we share, 4-6%, but it's on a very small base. Because LDA predominantly is cooler, so like you see, even cooler was muted, but since we started off in January, there is definitely growth of like 450% on it, but it's on an extremely small base.
Okay, sir. Thank you so much. Thank you.
Thank you. The next question is from the line of Natasha Jain from Phillip Capital. Please go ahead.
Good morning, sir. Thank you for the opportunity. My first question is more so from the trade perspective. Now, you had mentioned that 5-star production continues because cost savings probably would be maximum there, and then maybe 6-speed also would fall in that category. Now, 3-star is the majority of the market at 75% salience, and within that, I believe the cost hike is just under 3%. Having said that, newer inventory, when they come into the system, the cost difference may not be so much to the consumer. So do you think there could be steep price discounting in the third quarter to push the inventory to the trade by the brands?
So, I think this, as an ODM manufacturer, the brand strategy in pushing the sales in the market is something we generally don't want to comment on. But yes, like you rightly said, 5-star and 6-speed are the two products on which the increase because of the B is the highest, and we are seeing a continued production happening on these two categories. Whereas 3-star, the impact being minimal, we are seeing that most of the production happening only when it is required. So yes, that definitely is going to happen. How the discounting happens in market, I think that generally lies beyond our comment.
Understood. And sir, one more question. Given that we might see La Nina this year, therefore an extended winter, so fourth quarter, given the third quarter, a lot of inventory will get pushed to the fourth quarter, plus newer inventory will roll into the fourth quarter, and given an extended and a harsh winter, would you still maintain commentary of a flattish growth for RAC this year?
So Natasha, like I said, I see a best case of a flattish kind of growth for the industry. So we are keeping our fingers crossed. We believe that could be at best the best case for the industry to be flattish overall in FY26 for the reasons you just mentioned.
Understood, sir. Thank you so much.
Thank you. The next question is from the line of Hita from Monarch AIF. Please go ahead.
Yeah, hi sir. Am I audible?
Yeah.
So, hi. Just that most of my questions are answered. I just have one more question. With respect to Epack, could you throw some light on when Epack will be able to ramp up its production and break even, and at what margins will it operate?
So for Epack, the greenfield facility in Bhiwadi for manufacturing almost with a setup capacity of 3 million is now ready, and we have already started production from the mid of Q2. So from beginning of September we already started production in Epack of BLDC motors for air conditioners, and as we discussed, the facility is putting up, the production is ongoing, and we continue to stock up material for the coming season. So the approvals from all the key customers, including captive consumption at Epack, is now already approved, and so the production is ongoing, and we are very confident that for the next calendar year effort, the calendar year of 26, we will see a significant improvement in the overall capacity utilization. So with 3 million capacities installed, we see the capacities being utilized during the coming year. So that will be the first year of operations, and as it progresses, we firmly believe that there will be a need to further expand capacities depending on the response we receive. So now, as we discussed, yes, the production is ongoing, and we already have approvals from certain key customers, and the captive consumption of Epack is already approved.
Okay, sir. At what margins will Epack operate?
In terms of margins, we have to be competitive in the market. So being the first year of operations, I think a lot of innovations will happen as we ramp up productions, we reduce our, we work further on innovating and reducing our bill of material. So it will be very difficult to project the margin at this point of time. But yes, definitely with the first year of significant production, we will be in a better position to further improve in the coming quarters. So it's an ongoing journey. For the first year, we definitely want to be market competitive, gain a lot of market share, and prove our metal as a quality manufacturer. So that's the objective for the first year.
And as it is a component, so component definitely have a healthy margin. So going forward, sustainably, there will be a good margin in the component.
Okay. And so just one last question. What components do we supply to this energy meter sector? Are we seeing any major growth in that direction?
Yeah. So, for the energy meters sector, we started off supplying the molded parts, the chassis and the casings to certain large manufacturers in Jaipur and all. So, and we are seeing extremely encouraging or rather very good order book with them. So as we can see, the component growth has been phenomenal in the last quarter, and that despite being AC production being almost close to zero. So which means that most of the component sales has happened to non-AC segment, and in which energy sector definitely, the energy meter segment has definitely played a very significant role. And it's more of a secured order book, and we continue to grow with that set of customers.
Okay, so non-AC sector as of now includes only the energy meter segment, right? Or have you entered some other space as well?
There are other businesses as well in the component business. So as we can see, the growth in the component is extremely well. I'm seeing it's despite almost no sales for the AC components. So this the component business basically is largely non-AC. Energy meter definitely is a larger one of them, but there are other sectors as well.
Understood. All right. Thank you so much.
Thank you. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Ms. Bhumika Nair. Over to you, ma'am.
Yeah, I just want to thank all the participants for being on the call, and particularly the management for giving us an opportunity to host the call. Thank you very much, sir, and wish you all the very best. Any closing comments from your side?
So thank you, Bhumika, first of all, and thanks DAM Capital for hosting the earnings call today. Thank you all the participants. I hope we have been able to answer your questions satisfactorily. In case there are further questions, please reach out to us. Our IR team will definitely be available to answer them. Thank you once again.
On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.